Assalamu alaikum. Welcome to lecture 21 of ATX. So this is the overseas aspect of corporation tax. We have overseas aspect for other taxes as well. Like I've covered for CGT and income tax, overseas aspect of IHT. Then later we have overseas aspect of VAT. So similar way we have overseas aspect for corporation tax as well. Now here we are going to focus on company residence. We have done the similar thing when we did income tax for individual, okay, to identify the residence, domicile, deemed domicile, things like that. Now, new in ATX is the OECD model tax treaty, trading overseas, double taxation relief, planning situations, and summary. So starting with the overview, residence trading overseas. So under residence, we are going to see whether we are operating a controlled foreign companies, permanent establishment, double tax relief, and OECD model treaty. We are going to cover this technical areas in this lecture. Now, one question definitely you will get on overseas aspect. It could be any tax. You have to be prepared for the overseas because you are in advanced level. You are in professional level now. While you were doing tax, you were not being tested on this area. Mostly overseas are tested in ATX. Okay, so now for individual we have determined the residence. Now we are coming to the company. So a company is a resident in UK if it is incorporated in UK or incorporated elsewhere, but central management and control is in UK. So two things: either the management and control is in UK, either it has been incorporated in UK. Then it is known as company resident in UK. So now, what is the meaning of central management and control? That means where is your key operational financial decisions are being made in which country. HMRC will look at the factors like this: where are your board meetings held, where are the day-to-day decision managements are being made, what is the residence status of the directors. So HMRC will look for this factor to decide on the company residence. Now remember, one factor is not enough to tell you that you are a UK resident. Okay, so other countries may have different definitions for residency. So sometimes it's possible that companies might have dual residence. They might have two residence status. For example, let's say a company has been incorporated in another country and they are treated as a resident there, but the management and the control is in UK. So then based on that, it will also be treated as a resident in UK. Now, what is the implication of UK residence on tax? That's very important. That's why we are studying UK residence, because the impact on tax. If you are a UK resident company, you are chargeable to corporation tax on your worldwide profit. This includes all UK profit, all overseas profit. That means all your overseas branch profit. But there are some exemption election that you can make, that is in section 3, that later I will cover in this lecture. And other overseas income like rental income, interest income, that will be included, and chargeable gains. So for overseas branch, we have an exemption election to be made. We'll see that later. If that election is not made, it will be taxed. Now, next, OECD model tax trading. Here, OECD stands for Organization for Economic Cooperation and Development. Okay, as you all know, it's an organization of developed countries whose main purpose is to maintain financial stability and expansion of world trade. We all know this. Definition is not important for tax, that they will not ask. This is just for your introduction to OECD. So in order to avoid double tax between countries, OECD has published a model. Okay. Now, what is the significance of this treaty? Remember, UK has varieties of tax treaties with other countries. Okay. So when a new treaty is drawn up, the old treaty is renegotiated. Here, OECD model is used as a guide. Basically, it's a guide. Remember, you don't need the detailed knowledge of treaties. It is not required in your exam. But you are required to understand the impact of OECD model tax treaty on your corporation tax. That is important. The main function of any treaty is what? To avoid double tax and to decide which company has the right to tax the income. Now, the contents of the model treaty. There are some main areas that are covered in this treaty are as follows. Article 1 states that companies which are covered by the treaty are those resident in one or both of the countries involved. Article 4. You don't have to memorize these articles, by the way. You just have to know how a treaty works. That's why we are going through the content. Here, it explains the residence. Okay? Explains that residence is determined by the laws of a state, not by the model treaty. This includes a tiebreaker clause to be applied when a company appears to be resident in two countries. Like how you see in a football match, we have a tiebreaker. Same we have for this. Now, in this case, residence is where the place of effective management is situated. For example, where your head office, main company records and senior staff are located. Based on that, we'll decide the company residence. Article 5 deals with the meaning of permanent establishment. Now, Article 6 to 22 deals with the treatment of different types of income. 23 explains two methods for giving relief for double taxation. One way is you either exempt the income in one state and tax it only in one state. That means only one state will tax the entire income. On the other state, the income is exempt. Or the credit method, which gives credit in one state for the tax levied by the other. This credit method is also known as unilateral relief. Mostly we follow the second method in double tax. Now, so that's it for the model. Now we are moving on to taxing the overseas trading income. So normal provision in tax treaties is that overseas country will usually only tax income arising in its country from the commercial operation of a UK resident company if trade is carried on within its boundary and profits are derived from a permanent establishment set up for that purpose. The term country's boundary is very important. Okay, within a country's boundary is important as trading with. See, trading within and trading with the boundary is two different things. Okay, as opposed to within. Another country will avoid any liability to overseas revenue taxes. Okay, if it's with another country, you don't have to pay the overseas tax. But if it's within the country's boundary, then you are liable to the tax. Next, so the UK company, when you're trading within the overseas country and when you're trading with the overseas country, see the difference, the impact within and within. Your exam, you have to see, are you trading within or with? If you are trading within, you have a permanent establishment and concludes contracts in the overseas country. All your contracts will be in the overseas country. You are liable to UK corporation tax on your worldwide profit. Why? You will be taxed as a UK resident and overseas tax on the profits derived from the overseas trade. Not only that, overseas tax, you will be liable to overseas tax as well on the profits that you have derived in the overseas trade. UK tax as well as overseas tax. Now, when you're trading with means you are exporting goods to overseas customer. You are storing goods in that country for delivery. You are obtaining marketing information or advertising in the overseas country. So, you are not liable to overseas tax as profits all fall in the UK. You are not liable to overseas tax. You are liable to UK tax only. But if you are trading within the overseas country, you are liable to UK tax as well as overseas tax. That's the difference. Please go through this table. Now, permanent establishment is very important. Okay? It includes this. You have a place of management, you have a branch, you are operating through an office in the overseas or a factory, workshop or any mine of extraction of natural resources. If you are operating through the medium of any of this, it's a permanent establishment. Now, so if you have a permanent establishment, like you have a branch or an office or a factory in overseas, you will be charged to tax, okay, on the overseas profit by both HMRC under the UK residence rule and overseas tax authority under their own tax code. So you will be liable twice, UK tax, overseas tax, if you have a permanent establishment. That's why you are going to get a double taxation relief here. Now, you can make an election to exempt your profit of your overseas permanent establishment. How? It's possible. And remember, this is an irrevocable election. It's permanent. Okay? That means you are exempting all your profit of overseas permanent establishment from your UK corporation tax, such that there is no UK tax on the profit of overseas permanent establishment. But see, you are getting one benefit, you are losing another benefit. What is it? You are not going to get any relief available for the losses of that overseas permanent establishment in UK. You can't carry it forward in the UK profit. The overseas permanent establishment losses will remain there itself, no relief for it. And another disadvantage, you will not get UK capital allowances also, assets that are used by overseas permanent establishment, and no UK tax on capital gain arising in overseas. That's an advantage. No UK tax on capital gain arising in the overseas PE. Now, however, the overseas permanent establishment does not affect your corporation tax threshold for payment by installments or payment by 9 months 1 day. Does not affect. Or even in determining corporation tax rate, your permanent establishment will not have an impact, whether you make the election or you don't make the election. So the exemption election can be made anytime. It is effective from the start of the accounting period following that in which the election is made. Let's say you have made the election in accounting period is 2026. Following that year, that means 2027. So election will be effective from 2027. Once made, remember, you can't change, you can't go back. Applies to all your overseas permanent establishment, not just one. You might have 5 overseas permanent establishment. Applies to all overseas permanent establishment of that company once you make the election. Now, tax planning. So, it may not be beneficial to make the election if double tax relief means there is little or no UK corporation tax payable. Then why to make the election? You are anyway not paying UK corporation tax. So you are making the election not to pay UK corporation tax, right? If you are seeing you are paying little or no UK corporation tax payable because you are getting the double tax relief, that's why you don't have to pay, then what's the use of making the election? Or losses are possible. That means you are expecting that you are going to get you are going to get losses in the overseas branch in the future. Why? Remember, election applies to all the branches, current and future of that company. So if you are expecting more and more loss, you can utilize the loss. So if you make the election, you can utilize the loss. So in that case, don't make the election. Next, alternative overseas investment structure. There are alternative ways of setting up investment in overseas. There are 2 principal methods of setting up a permanent establishment, permanent place of business overseas. One, either you set up a branch or you incorporate a new subsidiary. That means you are setting up an overseas resident company. Note, if it's a branch or a division, it comes under permanent establishment and you are subject to both UK tax and overseas tax. If it's a subsidiary, new subsidiary incorporated overseas, and it is managed and controlled also in overseas, you are not liable to UK tax, you are only liable to overseas tax. Okay, because you will be resident in overseas for the tax purpose, not in UK. So these are the 2 differences for tax purpose. You should know this 2 structure. They might ask you this, very high chance, because they might want to know whether it is beneficial to set up as a branch or a new subsidiary. Please explain the tax implication. They might ask this question. So you have to know the differences. Now, alternative overseas investment structure. Okay, one, you are having a UK head office, overseas branch. Remember, this falls under single company. You are just having a branch overseas. It's just an extension of a UK head office. Next, on the right hand side, the right box, UK holding company HPLC has an overseas subsidiary S Inc. There are two separate companies. It's an overseas subsidiary. Now, overseas dividend. What do you do with overseas dividend? Treated the same way as UK dividend. They are exempt from corporation tax. They are included in augmented profit. Unless the dividends that you are receiving is from associated companies, in which case they are ignored completely for corporation tax. Now, this table is very useful. It's like a revision for you. Whatever I've told you till now, this is just a summary of it in a box. Overseas branch versus overseas subsidiary. So now we'll go through one differences. First, what is the scope and what is the basis of charge? If it's an overseas, it's an extension of UK operation. All profits arising taxed on UK company. If the branch is controlled from UK, then its trading profit is added to UK trading profit. If the trade is same as in UK, included in trading income and is available for relief of brought forward trading losses. Double taxation relief is available. You can elect for the profit to be exempt. If it's an overseas subsidiary, remember, overseas profits not assessed in UK. If it's left in overseas subsidiary, that means you have not remitted back to UK, it is left, profit is left in the overseas subsidiary, it will not be taxed in UK. But profits remitted to UK parent company may be chargeable when you are receiving it. But dividends not taxable. Interest income from loan to overseas subsidiary is taxable. Next, trading loss relief. For overseas branch, yes, you can relieve your trading loss of your overseas permanent establishment against your UK profit, unless the loss can be relieved in the country in which it arose. Unless you have some profit in the permanent establishment to relieve it, then send it back to UK. UK loss can also be relieved against the overseas PE profit. Is both the way, two-way. But if you go for the exemption, you will not get the relief. Overseas branch, only UK trading loss. You cannot surrender your overseas resident subsidiary. You cannot surrender the UK trading loss to overseas resident subsidiary. That's a disadvantage. Next, loss from 75% subsidiary resident overseas. Only this relief you will get. Next, so losses from 75% subsidiary resident overseas cannot be surrendered to UK parent. Subsidiary's loss cannot be transferred to UK parent. Next, capital allowances. For overseas branch, it is available on your overseas assets also. Assets that are located overseas, capital allowance is available for that also. Unless you make the exemption election, then no capital allowance. Overseas subsidiary, not available. You will not get capital allowance for overseas subsidiary. Next, chargeable gain. Capital gain will be computed using UK roll for overseas branch. Rolled over relief is available on reinvestment, same like UK. Capital losses also you can utilize. No capital gain or utilization of loss if exemption made. Overseas subsidiary, they will not be chargeable. Chargeable gain will not be assessed in UK. Chargeable gain of overseas subsidiary, they are kept separate. Next, impact on tax rate and payment, none. For overseas branch, no impact. It is not a separate entity. But if it's an overseas subsidiary, there is an impact because this is an associated company. So this will have an impact on your upper and the lower limit for the marginal relief, and the threshold for payment by installments are reduced. Next, where a new overseas operation is expected to make losses initially, it is better to set up a branch. Why? If you set up a branch rather than subsidiary, you can get your losses relieved in UK. Next, Once the overseas operation expects to be profitable, what do? You can transfer the trade to the overseas resident subsidiary company from the branch, so that then your profits will not be taxable in UK if paid as dividends. So you see, these are tax planning. You should know this tax planning. They will ask questions on this. Now, so you start as a branch. When you start as a branch, what happens? You can offset the losses. Okay, you can offset the losses. UK companies' losses can be offset against the branch profit, or branch's losses can be offset against the UK's profit. Next, then you transfer the trade. Okay, so the transfer of the trade represents a disposal of assets. It's like you're disposing the asset of the branch to the subsidiary, right? At what? At market value. So when you're disposing the asset of the branch at market value, it leads to a balancing adjustment. Okay, for those assets which qualify for capital allowances, and it leads to chargeable gain. Now, so when you're transferring all of the assets of the branch except cash to the overseas company in exchange for shares, you can make an election. See, where you are transferring all the assets of the branch to the subsidiary in exchange for shares, you can make an election. What is that election? To defer any gains arising until the overseas company is sold. That means you are deferring any gain rather than taxing the gain. You are deferring that gain. It will be taxed later when overseas company is sold. Now, so the deferred gain, this is like the rolled over relief. The deferred gain will be charged if the overseas company disposes of the assets transferred to them within the 6 years of acquisition. That means within 6 years that overseas company acquired the assets from branch, now they are disposing, now that deferred gain will be chargeable. Next, consideration should be given as to whether or not it is necessary to obtain the consent of the treasury. You have to get the permission from the treasury for the transfer of this trade to the overseas company. Okay, why? You just can't transfer as your wish whenever you want from branch to subsidiary, subsidiary to branch. You can't do that. Why? Because it's illegal. It is generally considered illegal in UK for a UK resident company to permit a non-UK resident company over which it has control to create or issue shares. UK resident company can't permit a non-UK resident company, especially those non-UK resident company over which that UK resident company has control, to create or issue shares. That's considered illegal in UK. That's why you have to take the permission of treasury. Next, an election. Alternatively, an election could be made to exempt the profits and the gains, not just the profit, also the gain. Do not forget the gain part. Often students, what do? They always focus on profit, exempt profit. No, gain is also there. Exempt profit and gain of the branch once profitable. So once the branch is profitable, make the election so that all your profit and gain are exempt. However, if this election applies, because it applies to all the overseas permanent establishment and is irrevocable, you can't reverse it. You need a very careful consideration before you give advice. Okay, now let us do question. Illustration 1. So you have to give the advantages of operating a branch rather than a subsidiary, assuming the exemption election has not been made. So these are the 3 advantages that has been given. One is the loss relief. You can get loss relief in UK for your trading losses. If an overseas branch is incurring loss, they can get it relieved in UK. But if it was an overseas subsidiary, there was no UK relief. Second, capital allowances. UK branch is eligible for UK capital allowances, also including SBA. Third, An overseas branch cannot be an associated company. You are not an associated company. Therefore, a branch will not have an impact in the corporation tax limit, as well as the threshold for payment by installment will not be reduced by an overseas branch. So make sure that you know these three advantages so that you can write in your exam. Overseas companies trading in UK. Now, a non-UK resident company can be liable to UK corporation tax on trading profits if it trades within UK, but not for trading with the UK. Trading within UK means you are trading through a permanent establishment in UK. Next, trading with the UK means you are exporting goods to UK, storing goods in UK, and advertising and marketing activities are done in UK. Next, corporation tax is charged at the main UK rate. Therefore, if it is when you are trading overseas, there is no small profit rate or marginal relief. You only get charged at 25% rate unless there's a double taxation treaty specifying a lower rate. Now, let us do a question. Illustration 2. So, when you're trading in UK, here you're supposed to advise Monk Inc. of its liability to UK corporation tax during the period from 1st September 23 to 31st December 24. Now, so this Monk Inc. is a large company resident in country of Scotland, manufactures mobile telephone and has been selling this in UK since 1st September 2023. Now they are selling telephone through a UK based agent and stored the telephone in a rented warehouse. On 1st Feb, they have rented an office and showroom in London, which was staffed by 2 sales manager and administrator from Scotland. Now they intend to incorporate a UK subsidiary company on 31st December 2024 to operate the UK business. There is no double tax treaty between UK and Scotland. So now you have to say whether they will be liable to UK corporation tax or not. So in this case, the first para says they will be liable to UK corporation tax if they are trading through a permanent establishment. That means you are trading within the UK. If you are trading with the UK, you are not liable to the UK corporation tax. So if you see from 1st of September to 31st Jan, they have employed a UK agent. See, these are the facts of the case that you have to give. This is how you always have to present your answer. First, you have to give this 3 line is a general answer. It is your textbook knowledge. Always have to start like that. Then only you have to link this to the case study. You should be able to link the facts with the case study. Like they have employed a UK agent. They have maintained an inventory of telephone in UK. All these are from case study. From the second para. First para you have to say if they are trading through permanent establishment, they are liable to UK corporation tax. If they are trading with the UK, they are not liable to UK corporation tax. This you have to say. Then we'll say that they have employed UK agent, they have employed inventory of telephone in UK, and provided that contracts for the sale of the telephone are concluded in Scotland. So now you have to decide whether they are resident in UK or Scotland. Here they will not be liable to UK corporation tax on profit because the contract was concluded in Scotland. That's the reason. So during this period, 1st September to 31st Jan, any profit is made, they are not liable to UK corporation tax. Why? It was concluded in Scotland. But on 1st of Feb 2024, what do? They have opened a permanent establishment in UK. See, this is one date. From this date to this date, they were this. Now this date, they have changed their status. Earlier they were not liable to UK. Now they are liable to UK corporation tax. So it has to be in different paragraph. There's a separation of line. Can you see this? So from first off, they have opened a permanent establishment. How they have opened? By renting an office and a showroom in UK. And also likely the sales manager will be empowered to conclude contracts in UK. So now this is, they will be liable to UK corporation tax from this date onwards to the date the trade is transferred to the new company. That means this date. Now, this is the conclusion, like the last para. At what rate corporation tax will be charged? Main UK rate. Doesn't depend whatever the profit is made in UK or by in the overseas. Why? No double tax treaty. See how they have linked this, that there is no double tax treaty, this information, how they have included in the answer. See all these things, okay? These are techniques that you have to apply in ATX. You should be able to link every point, statement given to you in the case study. Okay, so because there is no double tax treaty, you can use the main UK rate. Your profit doesn't matter. There is no double tax treaty between UK and Scotland. Okay. Now, the new topic, double taxation relief, DTR. So DTR, the UK resident companies can get relief for their overseas tax suffered in the two ways: treaty relief or unilateral relief. Treaty relief is given by one country reducing the rate of tax on the source of income or gain, or one country exempting the source of income or gain from tax, or by UK giving a tax credit for overseas tax suffered against the UK corporation tax payable. Now, unilateral applies if no double tax treaty, allows credit relief for overseas taxes, works in the same way as credit relief under treaties. Now, calculation of this relief. All overseas income must be included in the corporation tax computation gross, including any overseas tax suffered. If you are given net figure, gross it up. Relief is available for overseas withholding tax as follows. Withholding tax means any overseas tax deducted at source from overseas income. If the amount is given, withholding tax is given, add it back to the net income to get the gross amount. If the rate is given, see, if the amount is given, simply add it back to the net income. If the rate is given, gross up as normal. You should know the grossing up. Now, DTR is the lower of overseas tax suffered and UK corporation tax on the overseas income. Further aspects of DTR. If there is more than one source of overseas income, your basic DTR on each source is calculated separately. You have to use a column approach for computation. And when you are computing UK corporation tax on overseas source, okay, general loss relief. What are the loss reliefs? Current year, carry back, carry forward, group relief and QCD relief can be set off in the most beneficial manner as follows. First, you set off this relief against UK source, then against the source suffering the lowest rate of overseas tax. Remember this order. Now let us do question. Illustration 3. So you have to calculate the UK liability. Calculate UK liabilities, corporation tax liability. You have been given overseas branch and overseas subsidiary. So here, UK Limited is a UK resident company. Company's UK trading profit for the year is 37 and they have an overseas branch and overseas subsidiary not elected for the exemption. Now, the branch is controlled from overseas. It has a trading profit of 68,000. The overseas corporation tax is 26,000. Here they own 80% and resident overseas as a dividend of 8750. This dividend was net of withholding tax 4250. So here you have to do working. Okay, you have to add the UK and the branch. You have to do a column of format. So let us quickly do that. UK and the branch. Remember, overseas subsidiary will not be charged to UK corporation tax. And the total. So what is the profit of UK? 37 and 68. So here this is the trading profit, and you only have one source of income. So your trading profit in this question, your trading profit itself is your TTP, total taxable profit, because you don't have any other profit. So UK 37,000 and branch 68,000. Overseas subsidiary will not be taken because it is exempt from UK tax, and total 105,000. Now remember corporation tax. Are we going to have any? See, we have a UK profit. Okay. Now remember, overseas branch will not have an impact, but the subsidiary, overseas subsidiary, is an associated company. So because it is an associated company, it will have an impact in your upper level and lower limit, right? Lower limit. Now you have two associated companies. Overseas Inc. is an associated. So now your upper limit. Okay, I'll do the working here. Your upper limit was for corporation taxes what? 125,000. It's 250,000. Now there are two associated companies. One is the subsidiary and one is you. So 125,000. And lower is 50. Divide by 2, 25,000. So now, what about the dividend that you have received from overseas? Remember, you are a subsidiary. It's an intra-group income, and intra-group income are not included in augmented profit. Therefore, your TTP is equals to your augmented profit. TTP, your dividend received here, because it is from associated company, it is an intra-group. It is exempt. If it was from outside, then you have to add it with your TTP to get your augmented profit. Now TTP is equals to your augmented profit, and if you see the limit of the profit, what is it? It's 105,000. 105,000 falls between this two. So marginal relief applies. MR will apply in this case. Now will apply the marginal relief. Okay, corporation tax will be at 25%. We know that. So on 37, it's 9,250. On 68,000, 25%, 17,000. Total is 26,250. Okay, now less MR, marginal relief. Upper limit is now 125,000 minus the total profit 105,000 into the standard fraction 3 divided by 200. This is the formula for marginal relief, in case you forgot. Get it deducted from the total. It's 300. Now it is 25,950, and this one is now So there is another working that we need, that is allocation of corporation tax. Allocation of corporation tax, CT. Okay, first we have to find the average rate of tax. Okay, what is the average rate? You need before, what is the total profit? Just now you got it, this 25950. Okay, so just wait a minute. You have to allocate this among the UK and the branch now. That's why corporation tax before DTR, you don't know this too. That's why there's a working 2 for it. They have to allocate. Then less DTR. For DTR working 3. Okay, you need this. That 25,950 is the total. But you have to allocate it among UK and branch. How will you allocate it? Working 2 is for that. For that, you need average rate of tax. How do you get the average rate of tax? Total 25,950 divided by the total tax 105,000. It's the TTP, total TTP, I'm sorry, not the total tax, TTP, into 100 equal to, we need this percentage. We have done questions on this, 24.7143%. Now how much? CT on UK income, CT on overseas branch. So what is your UK profit? 37,000 trading profit, and overseas is 68,000. You need this rate now to apply 24.7143%, 24.7143%. You see why you need the average rate of tax to apply it. So then it's 9144 16806. So UK is 9144 16806. If you add up this two, you will get 25,950. Now DTR, this is separate working 3 for DTR. DTR, it is the lower of overseas tax, UK corporation tax. Already working 2 has been done. This is this 16806. Overseas tax. Overseas tax suffered has been given to you. They will always give you the figure. This one, 26,000. Lower is this UK corporation tax. Okay. Remember, there is no double tax treaty. So for the withholding tax suffered on dividend received, as the dividend is not taxable in UK. Okay, there is no double tax treaty for withholding tax that you have suffered for the dividend received. You have received a dividend, no? This, you have suffered this. But because there is no double tax treaty, okay, and also the dividend is not taxable in UK. Okay, we usually don't have double tax treaty for the withholding tax suffered on dividend received. That double tax treaty is for this corporation tax, please understand, not for withholding tax suffered for dividend received. The double DTR is only for corporation tax suffered overseas that we give. Okay, so now DTR is 16 You will not take it from the UK, you will take it from your branch. Six. So here it will be 91440 9144 city liability. That's what they have asked you. Now let us move to test understanding 1. Here same, you have to compute CT. UK trading profit is 900 in addition to overseas income, but no other income or gain. So here they have received rent of 119. It's an overseas property, and WHT withholding rate is 15% has been applied to rent received. Okay, now same way, see the nature is the same way. We'll do the column of format. I'll do down. Okay, so UK overseas rent and the total. Always this column of format you have to do. We have trading profit TP and overseas rent OR. Working one is there. UK 900,000, nothing, so total is 900,000. Overseas is nothing, and rent, there is a working for it. Why you have to cross it up? The rent that you have received 119 is net. You have to add the withholding. They have given you the rate 15, so you have to gross it up. So 119,000, 15 divided by 85. You have deducted from 100 15%, so 15 over 85 into 119,000, which is 21,000. You add and is 140,000. So the gross amount is 140,000. Okay, 140,000. Total 140,000. Now the TTP is 900, 140, 1,040,000. Now corporation tax at what rate? 25%. Of 900 is 225, 140 25 is 35,000, and 260,000 is the total. Now DTR, that is a working too. Marginal relief will not be applicable because there is no associated company, only one. Upper limit is 250 and your TTP is more than 250. So main rate 25%. DTR, there's a working too for DTR. Lower of overseas tax. Overseas tax, just now we got 21,000. You have done it. And UK tax. UK tax is 25% on what? Overseas income is 140, which is 35,000. Lower is 21, so 21 is the DTR. We'll deduct it from overseas rent and total. So now it's 225, 14,000 and 239,000. This is your corporation tax liability. It's very simple. Illustration 4. DTR with losses. Here they are making an overseas branch exemption, has not been made and has been made. So you have to calculate the corporation tax under both scenarios. You have been given, okay, so they are now owning two overseas branches, one in Paris and one in Rome. This is about a UK resident trading company known as London Limited, owning two overseas branch, one in Paris, one in Rome. It owns a 4% share capital, an overseas company, and owns an overseas property from which it receives rental income. So now you have the tax adjusted trading profit 38, overseas income, Paris branch profit has been given, and also there is a loss from Rome's. This is after deducting withholding tax of 40, after deducting withholding tax of 30. Now, dividend from Berlin after deduction of withholding tax. So now I have the solutions with me. So as you can see, this is a column format. Okay, we have three things: UK profit, number 1, number 2 Paris income, number 3 rental income. Okay, so now first, election has not been made. Normally we'll calculate. First, take the trading profit. So trading profit 38,000, this one of UK. Then we have an overseas. Then we have the Paris income. There is a work into it for overseas income. Okay, we have from both from Paris and rental income, and then there's an overseas branch loss, and that loss will be set off against. There is a note to it. So first we'll go to the working one to see overseas income. Okay, that is it, that the overseas branch loss is first set against the UK income, then against the overseas income with the lowest overseas tax rate in order to maximize the double taxation relief. So which countries having the lowest tax? The rental income, 13% compared to the 40%. So that's why from rental income we'll deduct, not from the Paris income, after taking from UK profit the loss. Now working one. So first, this 54,000 as it is will write, and this 218,457 here. Okay, this and this done. Now this is 40 over 60 and this is 1387 because we are adding up, grossing it up. So this is now is your new income, 25 and 90. Okay, it's 90,000 here, as you can see, 25. Both are overseas income, so both you are adding in the overseas income. Now the loss. How is the loss? 50,200. So that 50,200, first 38,000 you are setting off against UK. The balance is again the one suffering the lowest tax, that is this one, because they are suffering at 13% compared to 40%. This is lower. So rental income. Then you get your TTP. Since you have utilized all the losses of the overseas branch loss against UK profit, TTP, that means total profit from UK is 0. Whereas this is 90 and this is this one. Now the corporation tax, there is another working to it. Why? To decide their rates. So now let us go to working 2. Here no branch exemption. When there is no branch exemption, you take the TTP 328,900. Which one are you taking? This. Take this. Okay, and you have received a dividend of 2,700. Add the dividend received. Okay, so if you can see, even if without adding the dividend, you can see your TTP is greater than 250,000. Remember, with branch is not a part of, it's not a part of an associated, so it will not have an impact on your upper and the lower limit. Okay, you might be thinking why to gross up. You don't have to gross up dividend received. There is no double tax treaty for dividend received for withholding tax. As it is, you can take the figure and add with TTP. Okay, for dividend received, always you have to do like that because it's not taxed in UK. You don't have to gross it up. See, even dividend after deduction of withholding tax of 20%, right? You don't have to gross it up. Whatever dividend you have received, even if it's net, you can add it with your TTP to get the augmented profit. Why you have added? Because this is not from associated, it's from another company outside the group. So this you add, and this one is greater than 250, so the main rate applies, okay, which is 25,000, sorry, 25%. So you apply, and for DT3 there is working 3. Let us go to the working 3, this one. So now see, overseas tax we have already calculated here in working 1. Overseas tax suffered for Paris, and this you have covered. And UK corporation tax on overseas profit, you have already got it here in this table. It is this 20,500, 59,725. Here 59,725. So the lower of this two is 20,500 and the lower of this two is 32,643. So they are the DTR, 22,500 and 32. Deduct it and you get your corporation tax payable. Okay, so it is only this, rest is 0. This is when election is not made. Now the overseas dividend is exempt, but it is included in augmented profit. That's what we have done. Now coming to B, when you are making the election. So when you are making the election, what happens? You see, Paris income is not there. You only have rental income. Why Paris income is not there? Because overseas branch exemption. This is a Paris branch. This is now exempted now. Will not be taxed. You have made the election. Only rental income and this one will come. So now with election, you only have UK income and rental income. Okay, rental income you have already done 25,100. You have already got it from working 1. You don't have to do it again. Since you have done for A, do not repeat it for B. This is what these are the techniques, small areas. Same working as it is, you can take. You don't have to do twice because it's the same. Only this thing is Paris income will be removed from here, so you will get the TTP. Now there is a separate working for corporation tax. We'll see working 4, and for DTR there's a working 5. Rest all is same. So working 1, 2, 3, working 4. Now same, you add with the TVTB. If you see this is more than 250, main rate applies 25%. And now already in working 1 you have got the overseas tax suffered and UK corporation tax on overseas. This you will get from the table. 62,775 is from this table. It's this one, this figure, corporation tax on rental income. So the lower is 32,643 and you get your corporation tax. Done. Now if you see which one is higher, 30,132 versus 27,082. Without the election you are having lower corporation tax, isn't it? If you see here, without, so if you are being told to advise, you would choose this one, right? So here less corporation tax is payable if election is not made, because 1, you are getting a relief for the loss. Overseas branch loss could be offset against UK. Next, there is no UK tax on the Paris branch profit. Anyway it is not, because it is fully covered by DTR. You see here in A, part A, if you see here, this is anyway 0. Why? Because DTR is also 22,500, corporation tax is also 22,500. So anyway it is 0 through DTR. Next, so here if you compare the difference, the corporation tax liability is correspondingly higher. is 39,362 versus 27,082. That's much higher. So if you see this figure, alternative way also you could get. Alternative calculation is there. Very easy. This is your exam. In your exam you have to apply this. It's a very shortcut and time saving. What is the branch loss? 5,200, isn't it? So this branch loss, since you can't utilize it, against what? What is the corporation tax? 25. This much. This much is your corporation tax liability. You will get the difference. Right? So let's read the note. It is not possible to make the exemption election for the current accounting period or only future periods. Okay. Therefore, they would have to make the election before the current period begin, when the results would not be known. You can't make it for the current period. You have to make for the future period only. This is just this thing. Now, so we have finished. Now, let us move to test your understanding 2. Here also you have to calculate corporation tax for gold. Here also you have same trading profit of 300, overseas dividend received net 29%, 56,800, and overseas rent received net 17, withholding 4,980. They have a qualifying charitable donation of 100,000, overseas dividend received from an overseas company as a 5% interest. So now let us do that. So it's the same. Now you should be a little quick. Your UK income, your overseas, I will write O and I will write total. O means overseas. Then we have income. For UK is 300,000. For overseas, what do you do overseas? 4,980. There is a working required because it's net. You have to gross it up. So 4,980, you have gross it. It is 17. So 17 divided by 83 is 102. So this 102 you have to add with 4,980 becomes 6,000. So overseas income is 6,000. 306,000 is the total. Now nothing to do. Deduct QCD of 100,000 from UK income. Then this is 200, 6,000, 206,000. This is your TTP. Do not forget TTP. Then corporation tax at what rate? 25, working 2. What is it? With your TTP you have to add the dividend receipt because it is from overseas company. Okay, you can take the net amount 56,800 as I told before. So with this 200 you will add 206 you will add the dividend received 56,800 because you want to get your augmented profit. It is 262,800. So if you see overseas company, remember it is not an associated company. Therefore, full limit will apply. That means greater than 250. So greater than 250 means main rate will apply, which is 25%. Okay. How do you know that? He owns 5% only interest. From where he is receiving dividend, only 5% interest, which is less than 50. That is not an associated company. Okay. So now DTR. That's why 25% will apply. So when you are applying 25% to 200 is 50,000 and to 6,000 is 1,500, 51,500. Now you see all the questions are similar nature. You just have to understand the pattern. That's it. DTR working 3. So for DTR there's a working. Overseas tax offered lower of and UK overseas. So this is the UK overseas tax offered. And overseas, if you see, it is this one, 1020. So 1020 and 1500. 1020 is lower. So 1020 is your DTR. Here it is 0. Now CD 480, sorry, 50,000. I'm sorry, this is 50,000. So from 1500 you deduct 1020, it's 480, 50, 480. Okay. Unrelieved overseas tax. So initially DTR is dealt with on a source by source basis. This can lead to overseas tax being only partly relieved. Then what do you do with the excess overseas tax? The excess could be utilized like this: on branch profit and on rent or interest. If it's on branch profit, it can be carried back for 3 years against the UK corporation tax on profit from the same branch, or carry forward indefinitely, that means forever, against the UK corporation tax on profit from the same branch. It has to be the same branch and it has to be against the UK corporation tax on the profit. Against that you can utilize this excess overseas tax that has not been utilized through double taxation relief. Next, if it's rent or interest, there is no relief. That means only on the branch profit overseas tax that you have suffered you will get a relief, but not on overseas rent or overseas interest. There is no relief. Now this is the very important area which could be tested, and often this comes in ATX question. This area is very, what do I say, a popular area to be tested for your ATX, that is CFC, controlled foreign companies. If a company is setting up an overseas subsidiary, they will be attracted to countries with low rate of tax, known as tax havens, so that they can divert the profit from a company to those companies that are charging a lower rate of tax than UK. Definitely they want to charge to a country where the profits are charged at a lower rate of tax, even lower than UK. If it's higher than UK, why would they want to set up an overseas subsidiary there and pay high tax? It's no use, right? So they want to divert their profit from UK to a country where taxes are lower. However, there is an anti-avoidance legislation in place to prevent this from happening. That means to prevent the use of an overseas company for this purpose. This is known as controlled foreign companies. You are controlling these foreign companies. What are you doing? You want to lower your tax. You are manipulating the tax. That's why you are setting up this overseas subsidiary, to manipulate tax. That's why it's known as controlled foreign companies, CFC. Now, for your ATX exam, a CFC is defined as a non-UK resident company. It is controlled by a UK resident company, or it could be controlled by individuals also. UK resident individuals also. And it has artificially diverted profit from UK. It has to divert profit from UK. Otherwise, no use of CFC. If certain rules are met, then a corporate shareholder may suffer corporation tax in respect of its holding in CFC, known as CFC charge. This CFC charge could be asked from here. Okay. Like how degrouping charge is there for group issues. In my previous lecture, when I was doing groups and consortia, there was a degrouping charge when you leave the group with the asset in the gains group. Same way we have a CFC charge, which could be often charged on the shareholder. They pay this corporation tax in respect of their holding in CFC. It is known as CFC charge. But for the CFC charge, certain rules has to be met. We'll go through those rules. Now, there are exemptions to CFC charge also. Even if shares are held in CFC, it is rare for CFC charge to arise due to the availability of exemptions to the charge. These are the exemptions to CFC charge. So if one of the following exemption applies, remember CFC charge will not apply. If any of this exemption applies, any one of this exemption, just one is enough. Exemption applies, there will be no CFC charge. First, exempt period. The period itself is exempt. That means the first 12 months of an overseas company, the first 12 months of the overseas company coming under the control of UK resident will be exempt from a CFC charge, provided it continues to be a CFC in the following accounting period and it is not subject to CFC charge in that accounting period. So one of the other exemptions available now applies. Okay, now this exemption is intended to provide a period of time. Basically, this exemption is giving a period of time so that companies can restructure and avoid the charge from applying. It does not apply to newly incorporated companies. If you are a newly incorporated companies, this will not apply. Next, excluded territories. HMC provides a list of territories where rates of tax are very high to avoid a CFC charge arising. If a CFC is a resident in that excluded territory, no CFC charge arises. Third, low profit. If the CFC's TTP are 500,000 or less, of which no more than 50,000 comprises non-trading profit. You should not have more than 50,000 non-trading profit of that TTP. The fourth one, low profit margin. To CFC's accounting profit are no more than 10% of the relevant operating expenditure. Your accounting profit of the CFC should not be more than 10% of your operating expenditure. Tax exemption. The tax paid in the overseas country is at least 75% of your UK corporation tax, that which would be due if the CFC were a UK resident company. Okay, that means if you are a UK resident company, okay, whatever the overseas tax you are paying, tax that you are paying in overseas countries, at least 75% of the UK corporation tax, if the CFC were a UK resident company. So these are the 5 exemptions. If any of these 5 exemption applies, CFC charge will not apply. You have to know these exemptions. You have to see in your case study, in your exam, which of the exemption is there based on your question. Okay, we can't say this exemption or that exemption. Now the CFC charge. How do you calculate the CFC charge? So if none of the exemptions above are met, then CFC charge will apply. Okay, a charge to UK corporation tax. However, the CFC charge only applies to chargeable profit, if any. Chargeable profit is this: get the income of the CFC, not the gains. Only the income, not the chargeable gains. That has been artificially diverted from UK. That means your income has to be diverted from UK. That is your chargeable profit. On that, CFC will be charged. And how it is calculated? Using UK tax rules. Very simple. Now, CFCs are regarded as having no chargeable profit if any of the following conditions are satisfied. So if no chargeable profit means no CFC charge. First condition, CFC does not hold any assets or bear any risks under any arrangements or tax planning schemes intended to reduce UK tax. Okay. Next, CFC does not hold any assets or bear any risks that are managed in UK. Third, CFC would continue in business if the UK management of its assets and risks were to cease. That means the CFC will still continue to do their business even if the UK management of its assets and risks stops, ceases, ends. Still CFC will continue its business. In this condition, there are no chargeable profit, CFC charge will not arise. Now, if there are chargeable profit, CFC charge only applies to UK corporate shareholder if. Remember, this area is very technical area. It has a lot of rules. Okay, CFC charge, CFC exemption, what are the 5 exemption, chargeable profit, all those. So now, the UK company owns at least, remember this percentage is very important, at least 25% interest in CFC. UK company should have at least, that means 25% or more in the CFC. No CFC charge arises on individual shareholders, only on UK corporate shareholder. Now, This is how it's applied. Take the UK company share of the CFC profit, multiply by the main rate of corporation tax. See the note below. Less creditable tax. So DTR, double taxation relief, that would be available if CFC were UK resident. Less UK corporation tax on income of CFC that is taxable in UK if any. Income tax suffered by CFC on its income if any. Okay, there could be sometimes, there could be none. So income tax suffered by CFC on its income. These are creditable tax. So after that, whatever you get, the result is the CFC charge. We'll do questions, don't worry. Now, note, one thing you have to note about CFC charges, the UK company share of profit is usually apportioned based on the percentages of the shares held, and the main UK rate of corporation tax is always used for this charge. Always the UK rate, 25%. So you don't have to worry about any other rate. And based on the percentage of shares held, if you held 30%, 40%, 50%, based on that. Okay. So this CFC charge, what do? You add it to the corporation tax liability of the UK company that holds the shares in CFC. UK companies are required to self-assess their liability to CFC. Whether they are liable to CFC charge or not, they have to do self-assessment like income tax. Next, a clearance procedure exists for companies to check with HMRC how the rules will be applied in specific cases. They have to check with HMRC. Now let us do questions. Illustration 5. So we are going to do questions on CFC exemptions and the CFC charge. So here, advice. The tax considerations that Zoltan should consider before making its investment. Okay, when you're advising, you have to think from the various point of angles. Okay, now Zoltan is a large UK company with annual profit of 10 million. It is considering investing overseas and has identified two possible alternative investments where the corporation tax is 10%. That's lower than UK, right? They plan to buy a 70% stake in Doran, an investment company resident in Farland. They make regular annual profit of 2 million. And alternatively, they could invest in Burton, which is a trading company, but only produce profit of 400,000. It is anticipated that Burton, that means the one which is having this 400,000 profit, could make losses in future due to significant investment requirement to develop new products. There is no double tax treaty between UK and Farland. Farland is this one, the one which is making the 2 million annual profit. So now, first is dividend, next is CFC, then is the loss relief. So first we'll finish off with the dividend. That is the easiest. Always start with the easiest. It is highly recommended, and in your exam it is time saving also. Okay, so any dividends paid by overseas will be exempt. Okay, as Zoltan, if you see, he's getting 70% stake, right? So acquiring more than 50%, dividends will not be included in the augmented profit. Why? Because it's an intra-group. Because 70% they have acquired means it's an intra-group. So now, CFC. If you see, these investments, one is 70% investment, the other one is buying in Burton, which is a trading company having a profit. So if you see, both of these investments will be classified as CFC. Why? First, you have to identify what it is classified as, number one. Number two, why. You have to answer why always. Why this, why this, why this. First, what it is, then why. Because they are resident outside UK, number one. Number two, controlled by person resident in UK. Resident outside UK, controlled by person resident in UK. Two reasons are satisfied. So now, what happens? This means they can have an additional tax charge. Okay, we'll see. First, We'll finish off with Dawn, the 70% investment, the investment company. So the investment here does not appear to satisfy any of the exemptions. What are the 5 exemptions? Remember, you don't have to list all the 5 exemptions. No. You have to see whether they satisfy any of the exemptions or not. You have to remember those exemptions in your head. Time period exemption, tax exemption. Okay. Just now we have gone through the list. You can't forget it so soon. Okay. So there may be a CFC charge. Because it does not meet, there may be a CFC charge in respect of this shareholding. Okay. If they are chargeable profit. We'll see below whether they are chargeable profit or not. Now. So the exemption for the first 12 months of the company coming under the control of UK resident may apply. See, out of those we are saying they do not appear to satisfy any of the exemption, but the first exemption, time period exemption, may apply, but only if there is no CFC charge in the following period. Okay. Now moving to the next one, we have finished with Jordan, saying this may apply, but if this happens, this may not apply. Burton, if you see, it should have a profit of less than 500, right? It has profit of 400. It has profit of less than 500, and they are from trading. So this will be covered by the low profit exemption. So because low profit exemption, no charge on Burton, but Dawn might be charged or might not be charged. So we'll just leave it like that. Coming to loss relief. Remember, they both are overseas resident company. So it's not possible for losses to be surrendered from an overseas resident company to a UK company. It's not possible. Okay. Now, so this is, you are just advising. You are not calculating anything. You are not doing anything. You are just being told to advise. So keep your answer specific to the verb. Now we are moving on to test your understanding 3. Explain which of the companies are likely to be exempt from the CFC rules. So here these are the 3. You have to explain which company are likely to be exempt from CFC rules. Okay. They have 3 wholly owned overseas subsidiary. First one, Alcock, resident in some country, corporation rate is 8%, investment company, taxable profit is 40. So first we'll go through the first one. Tell me, first one will be exempt or not? This will be exempt. This will be exempt from CFC charge. Why? See the profit. Very easy. Taxable profit is below 500,000. Sorry, below 50,000. It's from trading, right? It's an investment, non-trading profit. It's an investment business. Non-trading, the last exemption. It satisfies the last exemption. Non-trading profit is, that is the low profit limit for non-trading profit is 50,000. So this is less than 50,000. 40,000, right? It's less than 50,000. That's why they are exempt. Next, Barbout, resident in another country, corporation tax is 20. Again investment, profit of 2 million. Tell me, they also will be exempt. Exempt. Even 2 is exempt. This is also exempt. Why they are exempt? The reason is different for this. Because they are resident in a country where the corporation tax payable is likely to be at least 75% of the tax that would be payable in UK if the company were UK resident. So here it is time exemption. I'm sorry, not time. It is tax exemption. Look at the tax is 20. So 75% of UK corporation tax is what? 25%. Okay. And 75% of 25 is UK corporation tax is 25. So 18.75. So here it is 20%. More than that. So that's why at least 75%. That means more than 18% of corporation tax overseas means tax exemption. Third one, Black, also resident, where CT is 5%. They make a nurse XA and has a profit of 750,000. Here they do not satisfy any of the exemptions, so CFC charge will apply. But CFC charge will only apply if they have chargeable profit. So here CFC charge will apply only if they have chargeable profit. Now test your understanding 4. Show the effect of CFC on their corporation tax payable. That means CFC charge will arise here. So they have a taxable profit of 20. UK company having taxable profit of 20,000, holds 90% of overseas subsidiary resident in Maxia. This subsidiary falls within the definition of CFC, so you don't have to worry whether they are CFC or not. Already question told you. They have 600,000 of profit, 75% of which are caught by the CFC legislation and stand to be charged. The tax payable in Max is 5%. So now you have to, what do you have to do? What is the starting point for this? You have to find the charge. Okay, so just now we have done the formula. So first TTP, total taxable profit, TTP, will start with this according to the formula. What is the TTP? It is 20,000. 20,000. Next we add corporation tax at small profit rate, because TTP is less than the lower limit also. That's why this 20,000 is less than the lower limit. It is less than 50,000. So corporation tax at small at 19%, because 20,000 is less than 15. So 19% of 20,000 is 3,800. Now extra UK tax on CFC profit. Extra UK tax. Okay, there are extra UK tax on CFC profit. Okay, so remember UK tax on apportioned profit at the main rate. So how do you get it? 25%. It is always at 25%. Then how much did you own? Remember, you have to apportion it. You have hold 90%. So it's 90% multiplied by 75%. Okay, into 600,000. What is the profit here? See, they told 75% is caught by CFC legislation, only 75%, and profit is 600,000. Okay, so 75% into 600,000. Okay, the whole thing will be equal to 101,250. So 1, it is 101,250. You deduct double taxation relief. Okay, DTR for tax suffered in Maxia. So tax suffered in Maxia is how much? They told it's 5% tax, corporation tax, into you have hold 90% in CFC. Always you are holding, a portion into holding, and it is how much is caught by CFC legislation? Only 75%, and into 600,000 the profit. Here you don't have to do lower of overseas tax suffered in UK tax. That thing you don't have to do when you are doing CFC charge. Straight away like this, 2250 deduct. It's 81,000 that you have to add with this corporation tax of UK, 3,800. This part is for CFC extra. So 81,000 plus 3,800 is 84,800. Okay, this is the total UK corporation tax payable. The last part of this lecture we have arrived is planning situations. This is an important professional skill. To master in ATX is your ability to evaluate and give advice on number of different options, which may require you to consider overseas aspect of corporation tax. You should be prepared to discuss the tax implications of 2 alternative strategies and give reasoned recommendation on which is the best. Now we'll do a question. The last question, final question, it's a tax, it's your exam standard question, and make sure that you do questions from revision kit from now onwards, as you are towards the end of this lecture, towards the end of the syllabus of ATX, and also exams are just right away. Okay. Illustration 6, expansion overseas. So here you have two projects from which you have to advise which one to go for. Okay. One, assume that FY 2023 rates and allowances continue into the future. Okay. This is a full-fledged question how in ATX it looks like. So you are supposed to write this is usually question number 1 for 35 marks. Okay, so write a report to the board of directors which covers the tax consequences of these two projects. Include any suggestions that you consider would improve the company's tax position. So you can give some of your suggestions. Solution is being given, but before going to the solution, let us first see what are the two options. Okay, so basically they have given you that you are a tax advisor, this is your role, and now you have been successful since the formation of 7 years. Now the TTP is 1 million each year, so now they want to expand. They are considering options. There are two options given. You have to write a report on it. First one, you buy a stake in Preachco. Next, you set a new branch to expand sales. So first let us go to the first one. Okay, it's a small company which has developed a new food storage product. So this company is specializing in manufacture and sale of kitchen appliances. Okay, now he is going on to buy a stake in a new food storage product. At present, Preachco is wholly owned by Helena, who is willing to sell Northingen Limited at 60% stake in this one for 350. Although sale is prepared to consider offers for higher stake, they will continue to own the share that she does not sell to the company. Now, this company has made losses in the past, but it is expected to be profitable in future. At 1st April 2024, the trading losses brought forward was 70,000, capital loss was 55,000, and company has rented some office space in addition to its manufacturing plant. For the year to 31st March 2025, the company expects to make a trading loss of 48. So they are considering a price of 350. Okay. Assuming any share purchase will take place on 1st Feb 2025. Now, next, when you are setting up branch. This branch could be located in UK, but as the directors have been keen to export, they feel it is better to locate it overseas, where there is no double tax treaty with the UK. Branch is expected to make loss and then produce profits of 200 per year. Now, so tax system operates in a similar to UK and Lagos. Tax on branch profit 22%. So now, write a report. So see, when you are writing a report, your format matters a lot. Here, this is the place where you are going to get your professional skill marks as well. This also will be tested along with your technical marks. Okay, so first let us see the solution. This is the report. You are writing a report, and this is the format. Very important. To whom you are writing, from whom, the subject. You have to write a subject. So you are writing to the board of directors. Question itself told you in the beginning. From whom? You are a tax advisor. What is the subject? See, subject keep 5 to 6 words. Your subject should not be too long. It should not be a sentence. Don't copy paste sentence from the case study. Keep it relevant, short, and to the point. So the subject you can get it from the requirement also. The requirement asked for the tax consequences of these two projects. So that could be your subject, tax consequences of the two investments. Okay, so now you have to write it in paragraphs like this. You have to leave space. Very important, very relevant. Report has to be in paragraphs. And wherever you are writing a subheading, make sure it's bold, because you are typing this out. It's on a CB platform, you have to type it, so it's in bold like this. First one, buy 60% stake. Second one, increase purchased to at least 75%. Okay. Just wait a minute. This is, you are buying a 60% stake when you're buying a stake in Preachco. The next, when you're setting a new branch to expenses, set up overseas branch versus overseas company instead of branch. There are two. Okay. And then if you see the advice, this advice is very small, but your body length is very big. Advice is 3 to 4 lines, or maybe 2 to 3 lines, because you're supposed to advise. So now, first we'll see the tax consequences. Okay. See, first, always before going to tax consequences, when you are either you are having a branch or a subsidiary, always see to it whether they are an associated company or not. This is number one, because based on this will have an impact or it will not have an impact. If you are buying a 60% stake, greater than 50, it's a subsidiary, so the company will be an associated company. Okay, when you have purchased it for the whole year. Number one point is this, very important to identify that. So because once you have decided in this stage, number one stage, if it's associated, it will have this implication. If it's not associated, it will have this implication. Now the next one, implications of associate companies. Now because it's implicated, what happens? Your corporation tax will be divided by 2. Limits will change. This you have to write in second paragraph. You see how you're not writing everything like you're not putting everything in one paragraph and crowding it up, so it looks very untidy. It should look professional, it should look neat, it should be very easy to read, easy to follow through. So from this paragraph to this paragraph, see the link, how the link is there. First is about associated company, then if it is associated company, the limits will be divided, so the implications. So see how it is following through from one paragraph to another. That's very important when you're writing a report. Often students don't know how to write a report, how to start, what should be the main part, what should be the conclusion, what should be the introduction. They often stumble. So the limit will be divided by 2. Okay, but remember, this will have no effect on the rate of tax. In this case, you have to mention the name of the company, must, whatever the company given to in the case study. Why? As they already pay tax at the main rate. If they are already paying at main rate, it will not have an impact. Otherwise, it will have an impact. Why? How do you know they are paying at the main rate? Again, we'll go to the case study. You see, it's being successful. Okay, they are making 1 million, so it's more than 250. If you divide that 250 by 2, it's 125. Still, it's more 1 million TTP. It's a huge TTP. So they will be paying at the main rate. Okay. Next. So if you divide the 1.5, this one. If it's more than 1.5 million, that's the one, right? However, the 1.5 million corporation tax profit threshold will also have to be half to 750 now. It will be divided by 2. Okay. Your augmented profit. But with the profit of 1 million, they will have to start paying tax by installments. So because now they are big companies, but not until this year, next year, that is 31st March 2026. Okay. So you have to say whether they have to pay by installments or not if they're big companies. Now, once more, they have talked about something about VAT. If they have mentioned anything about VAT, that you have to say. Here, account 31st March is the accounting reference date. Okay, and it is registered for VAT making solely taxable supplies for VAT purpose. Now, so because it's a subsidiary, they are group now, right? Isn't it? They are group. So that's why you can even talk about VAT group. VAT group is the third implication. Third point. You see there, you're not including VAT into corporation tax. You are keeping this separate. This is the third paragraph. Third point. Talking about VAT group. Because which two companies, this and this, they are part of a group. 60% they have acquired means subsidiary. So they can join a VAT group, isn't it? So what happens? They can join a VAT group and it will be useful also. Advantage you have to write. Because this will be useful if there is to be much trading between the two companies, as supplies within the group are ignored for VAT. Why is it important? If they're in the VAT group, remember, supplies within the group are ignored for VAT. If they fall in the VAT group, anything among them, if they are trading, will be excluded from VAT. See, you are giving implications of tax. They didn't say corporation tax. Did they give you corporation tax? They told tax consequences. They didn't say only corporation tax. In your main exam, all the type of tax you have to write. If it is implication, if there is an implication on income tax, that you have to write. If corporation tax, that you have to write. If IST, CGT, VAT also you have to write. They are interlinked with each other. VAT, corporation tax, VAT with income tax, VAT with CGT. All these are linked. They are not separated. That's why we are writing VAT here. Even this will help you to reduce your VAT. VAT is a tax. Then you have to talk about dividends. Dividend is the next step. Next point. Fourth. So because they are associated, any dividends paid by Frisch to Norton will be exempt, and they will not be included in augmented profit. This is what you have to write, whether they are included in augmented profit or not, because what they are in same group. So intra-group dividends are not included in augmented profit. Only dividend from outside the group are included in augmented profit. Fourth point. Okay, this is how you collect 1 marks each. Next point, next paragraph. You see, each paragraph has separate points. Now you have to talk about reliefs. Any relief. See, they are part of a group now. So what relief you will talk? Mostly group relief. And they are making transactions among each other, gain and all. So you can talk about capital gain also. But in this case, you have to say whether the group relief is available or not, with the capital gain advantages available or not. In this case, there is no group relief or capital advantages available within a 60% stake. It's a 60% stake. You should have a 75% group for you to have the relief. So this is point number 5. You see, from the first line itself, I am able to tell what is then the paragraph. For example, the first paragraph it's about associated company. Second is about dividend, the corporation rate. Third, VAT group. Fourth, augmented profit. Fifth, reliefs, types of reliefs, because they are group, so group relief. So now always check, when group relief is not there, what is next? Consortium, because less than 60% consortium could arise. No, we told if it's more than 5 and less than 75, consortium could arise. But in this case, a consortium does not exist. Why? Because this requires at least 75% of the shares to be owned by companies. Helena could incorporate a company to hold her shares, and then a consortium would exist between Northern to claim the 60% of shares lost from 1st Feb 2000 onwards. See, Helena through a company could hold shares. Okay, it should be owned by companies. If an individual is having shares, consortium will not arise. It should be a company. In this case, we'll read once again where they have talked about Helena. Okay, so Frisch company is wholly owned by Helena, who is willing to sell for 350. Although she is prepared to consider offers for higher stake. Helena will continue to own the shares that she does not sell to this one. Helena, individual is owning. That's why. Okay, so now next 5. What is the sixth? See, there's a change in ownership. Sixth is change in ownership thing. Impact it will have. It's a big thing. So this purchase represents a change of ownership. Okay. Why? Because more than half of the shares has been changed hands. If there's a major change, you have to talk about change in nature or conduct of trade also. If there's a major change also within 5-year period, commencing 3 years before the change in ownership, then trading loss of 70,000 plus 40,000. Losses acquiring from this 1st of April to 1st of Feb 2000. If you take it in terms of months, it's 10 months of 48,000. How did you get that 40,000? Simply 10 months of 48,000. Okay. This will lapse. This will lapse and you cannot carry it forward against the future profit if there's a major change in nature and conduct within this period. We'll go back and check against the losses. Very easy for you to forget this thing. I'll highlight it. This 70,000 and this trading loss of 48,000. Okay, but it's only from 1st of April to 31st March 2025. No, they have given the dates. In fact, it's from 1st of April to 1st Feb. Sorry. Okay, now so this is the continuation of it. If there is no major change, even if there's no major change in nature or conduct, losses will not be able to be used by this one for the next 5 years, as there has been a change in ownership. Because there has been a change in ownership, even if there was no major change in nature or conduct, still you can't use the losses. Why? For the 5 years you can't use the losses because ownership has been changed. Now what's the next, the last one? This is this one, similar thing. 7th point. 7th point is about substantial shareholding rules. Wherever shares are there, you are selling shares, you have to talk about SSE. This applies or not. So provided that they hold the shares for at least 12 months, okay, any capital gain on the sale of the shares will be exempt under this rule. Now increase the purchase to at least 75%. See, we'll quickly go through this. So here, buy a stake. Okay, now so what is the impact? What is the include any suggestions that you can consider would improve the company's tax position. First one, you are giving the tax consequences. You gave the tax consequences. Now this one is your suggestion for improving the tax position. Suggestion for the first one, whatever the issues were there in the first one, now you will improve it by giving a suggestion. What is your suggestion? You are having 60% holding, right? With this 60% holding, you are not able to utilize group relief. But what if you increase it to 75%? You can use a group relief. You can claim your losses, surrender your losses. So that's why this is a suggestion. S. You see, if you increase it at least 75%, if you're holding at least 75% of this, then all of the above consequences, don't write all the consequences one after the other again, no need. If you write all of the above consequences, it's a report, it's understood, examiner will follow through. Okay, that's why whatever you write before has to be clear cut. So later on you can refer to whatever you have written before. So then all of the above consequences will occur, but it will also be possible to create a group relief and capital gain group. These two advantages you will get. You can create a group relief and a capital gain group. That was not possible with 60%. So here this would enable the group relief. Losses from this date onwards, they can group relief. How? Feb, March. Remember, it's 31st March. So for 2 months, this 48,000, this is 8,000. This you can surrender to be used against the company's TTP. You need some calculation. Some calculation will be there in the report, not just writing. Okay, like this. Next. But one thing is there. What about the brought forward losses? Remember, it is not possible for the company to make use of their brought forward losses as a group relief. This is the reason why you have to know all the rules of group relief. For brought forward losses, for capital losses, for property losses, for trading losses, all the kind of losses. What you can carry forward, what you can't. This is why you have to know the rules, and now you have to apply. It's the case study like this. Okay. So it's not possible for you to use the brought forward losses as a group relief for 5 years. 5 years you can use it after F joins the group. This is the rule of the group relief. You have to go back to my group relief to check this, my previous lecture. Nor can they make use of the capital losses brought forward. Even capital losses brought forward you can't make use of. Why? They are pre-entry losses. Use the word terms using like this: capital loss brought forward, capital gain group, 75% group, surrender, pre-entry loss, consortium member, consortium company. These terms will give you marks, but don't use it just like that. If it's applicable, only you use. So these are what? Pre-entry losses, which can only be used by against the gain on the assets it owned when it joined the group or purchased subsequently from third parties. Only then they can use this pre-entry losses against the gain. Now they told you to advise. Now is your advice. You have given the suggestion. Now what is your advice? Your advice. See, the best way is negotiation. Company could negotiate with Helena to buy at least 75% of this. Any increased price as a result of the available losses should also be considered. Even increased price should be considered if there is no major change to the trade within the 5 years of the sale. And there hasn't been any major change in this 3 preceding years. Okay, you'll get some professional skill based on your advice, the quality of your advice that you are giving. If it's practical, you are going to get your professional skill marks along with it. If it's not, you are not going to get it. This is up to the candidate. Now the next, when you're setting a new branch to expand the sales, first implications, then you will give the suggestion. Okay. So now, when you're setting up branch, what happens? Remember, overseas branch will be taxed in UK. They are taxed in UK. So because they are taxed in UK, the initial losses also can be relieved against the UK profit. Number 1. Number 2. Tax credit. Okay, let's go back. See, they are paying 200,000. First they are making loss, then 200,000, and at 22%. So this extra 200,000 profit in UK, they are subjected to 25%. Although credit would be given for the 22% tax payable in that company. Whatever you have paid in that country, 22% tax credit will be given to in UK. Next, once the branch is profitable, you can make an irrevocable election so that you can exempt the branch profits in UK. This would avoid extra 3% tax, 25 minus 22. But see, you should always give if you are having a disadvantage along with advantage, try to give both the sides. Okay, not just one side. Advantages, yes, 3% tax you are saving. Disadvantages, if further branch losses were made in future, they cannot be used in UK because it's an irrevocable election. When you're writing an election, always write next to the election whether it's irrevocable or revocable. Very important. Next. So any goods shipped from UK to sell will be treated as exports and will be zero rated supplies in UK because they export zero rated supplies. This is from the point of VAT because they mention VAT. Now you are giving suggestion. So you are saying this. Now you are simply giving a suggestion. So if the company is set up instead of a branch, if you are setting a company instead of a branch, what happens? There is no relief for initial losses. If you are a branch, you will get relief. If you are a company, no initial losses. This loss will remain in that country. That is about loss. But what when you are profitable? Any profit that are paid by the parent as a dividend will be exempt in their taxable profit, in nothing as taxable profit, because dividend are exempt. As they owned, why? See, if you are a company, okay, then it will be exempt. Why? Because as they own 100% of shares, dividend will not be included in the augmented profit for the purpose of determining rate of corporation tax, and company is liable to pay tax by quarterly installments. Therefore, next, if you see the rate, even though the rate is lower, this should not cause any problem under the CFC rule. See, when the rate is lower, then UK always see whether CFC it will have an impact on this or not. In this case, it will not have because Bajor is more than 75% of the UK equivalent tax. 75% of 25% if you take, it is 18 point something, and you are paying 22% in Bajoria, which is more than 75%. That's why this should not be an issue. The issue will be if it was not at least 75% of UK corporation tax. Okay. Next. So all these are advantages. That means you are giving solutions to set up as a company rather than branch. You are saying better to set up as a company rather than branch because branch has this tax implication. Now, subsidiary, remember, it's a company means subsidiary. It's an associated company. Subsidiary associated company. This will reduce your corporation tax limit as well as payment threshold. Now you will talk about double tax treaty. So as the UK has no double tax treaty with this, any trading between UK of any size and related companies in this one will be subject to transfer pricing rules. We have covered this before. Can you recall? Okay. So therefore they will need to ensure that goods sold to the new subsidiary are sold at an arm's length price. This is the place where you can get your professional skill marks because you are thinking from various angles. Now, advice. So, advice would be what? Start the overseas operation as a branch first to obtain the relief for the losses. Once it is profitable, transfer it to a company. From the branch, transfer it to a company. Or make an election so that you can exempt the branch profits in UK. Very shortcut advice. So that's it of this lecture. Let us summarize the overseas aspect. We started with residence and trading overseas, CFC and permanent establishment. Under CFC we went through the 5 exemptions. If they do not apply, then there's a CFC charge, and how it is calculated is also there. and then permanent establishment, then DTR, double tax relief, OECD model treaty. So permanent establishment is through overseas branch, overseas company trading in UK, overseas subsidiary. Now DTR, you can get credit relief, either withholding tax or relief for unrelieved overseas tax. Now then the treaty relief. So that's it. Thank you for watching, and I shall see you in the next lecture. That is the last lecture under your company, under your corporation tax, that is closed companies. A new topic, totally new for ATX. And make sure that you watch my previous lecture. If you have missed out any of the lectures, you can go back to my ATX playlist and watch out the lectures. Email me if you want the ATX slides. Thank you.